No surprise here, but this podcast is brought to you by AssetDash. AssetDash is the best way to track all of your investments in one place. We support over 100 different platforms and blockchains, and everything from crypto to stocks to DeFi, NFTs, banks, and more. Simplify your investing life with AssetDash today. All right, what's up, everybody? Super excited to have LeClair on the podcast. I think it's a great time to have him on. Lots of things happening in the market, lots of things happening in the Bitcoin space. I was actually reading one of his Bitcoin Magazine Pro articles yesterday called Brewing Emerging Market Debt Crisis. Fantastic piece. We're going to jump into that. We're going to jump into CPI. But before we get started, Dylan, thanks for jumping on. If you can provide a quick background on yourself.
Yeah, thanks for having me on. My name is Dylan LeClair. Work for Bitcoin Magazine and UTXO Management, which is kind of under the same BTC Inc. umbrella, parent company. Focusing just on the Bitcoin market, Bitcoin the asset, documenting its kind of financialization process, monetization process, and kind of it's all baked in with this underlying thesis that super long term. And this thesis was kind of why I dropped out of college my freshman year, after my freshman year in 2020, which is that Bitcoin's the best money ever. And it's it's kind of going through this monetization phase, and so there's obviously a huge boom and bust, but just kind of mapping it out. And we with what I do currently with Bitcoin Magazine Pro, it's a very data driven approach. So not so much trading the asset, but trying to map out what's happening on the day to day. Derivatives, legacy markets, volatility. We like to look at some of the on-chain data as well. It's pretty useful, some of the stuff you can see there. So yeah, I mean, we cover all the macro stuff and trying to just document what's happening with visuals and some analysis. So that's my day-to-day. But yeah, just excited to dig in.
Awesome. Well, I think a good place to start is with the recent CPI numbers that came out a few hours ago. You've become one of the better follows on Twitter for macro related information. What was your initial reaction to the CPI numbers?
Yeah, so I mean, 9.1% year over year. I think the really telling increase in why the markets initially sold off is the continued increase and acceleration in the month over month prints. So that's obviously not good, and that's why you're seeing the central banks around the world just continue to ramp up tightening. It's kind of an interesting dilemma because it does monetary policy is probably not the right tool to solve for structural inflationary issues that are more so driven by supply side dynamics, whether it's energy constraints, the lack of commodity capex investments over the last decade or two. These are things that can't be solved with tightening up monetary policy. But the Fed and really other global central banks, I think, committed a policy error early in 2021, or really kind of later into the year by continuing to just print massive amounts of money. They just kind of fed the flame, and for the longest time, since basically the Great Financial Crisis, they could stoke financial markets with as much monetary stimulus as they possibly wanted, and there really was no CPI inflation, and a lot of that was just kind of these big picture ideas of globalization and kind of technological deflation. So we saw, CPI barely got above 2% for the last decade, despite, the S&P or M2 or the bond market increasing at, 10, 11, 12% CAGRs. So now inflation's arrived in a huge, huge way, and there's a problem. So I think whether inflation's peaked or not, right, in the year over year sense, I don't think it's as important as recognizing that we're seeing a structural shift, this huge structural shift in maybe monetary policy, but also just kind of these inflationary dynamics in terms of CPI. The thing that allowed CPI to be so low for so long was globalization, right? And kind of exporting all of this labor to emerging markets around the world to do it for cheap, right? Americans get all these cheap goods, a never-ending amount of them for decades on end, because we're kind of hollowing out our manufacturing and exporting it everywhere else. And then COVID happens. And now what we're seeing with the Russia-Ukraine conflict and the trust has eroded, one, And two, everybody realizes for national security interests and just kind of political pressure, like we need to reshore manufacturing, we need to put our own self-interest first. And so even if say CPI year over year inflation goes from 9.1 to 8.1 or 7.1 or 6.1, that's the derivative of inflation coming down. That's not actual prices declining. That's just prices increasing at a slower pace. Right. So there's, nothing has really been solved, right? Even though oil and copper and some of these really important commodities have fallen off, you're just looking at the kind of the rate of change of this inflation. It's still a lot more expensive. Oil's still flirting with $100 a barrel. And there's some big problems there as long as these prices persist.
Yeah, totally. I think one of the numbers I was looking at is majority of this CPI, the highest increases were around oil and gas. And I've seen some predictions that could see oil going as high as 300, right? I think that's been floated around. So I guess in general, what do you think has changed? So in 2020, 2021, the inflation narrative worked as a positive for Bitcoin. And I think that played a huge role in the all-time high run up to 65K. We now are still in this inflationary space, and the narrative around inflation is still extremely strong, but prices obviously decreased a bunch from the all-time high. What do you think was the structural shift that led to that?
Yeah, so I think kind of posing Bitcoin as a CPI inflation hedge was kind of the wrong framing from the start. I kind of view Bitcoin as, it's just an entirely alternate monetary system altogether, right? 21 million units, yada yada. We kind of know the drill. But what's really, I think Bitcoin is better framed as a monetary debasement hedge or a monetary debasement escape or alternative, right? So like the reality of our credit system, regardless of what CPI inflation is year over year, for a fiat credit monetary system to exist, to persist, you need perpetual expansion of the number of units in the system. And every once in a while, things get out of hand, whether it's with asset bubbles or CPI or both at the same time. And the central bankers have to try to reel in the number of units in the system. But because money in this current system is lent into existence, like dollars are created through commercial bank lending. The central banks don't even print money, they print bank reserves. Commercial banks lend the money into existence. And every dollar that's lent into existence is lent into existence and owed with interest. So there's never enough money in the system to pay down all the debt. Which actually requires, which is why we need perpetual credit expansion to keep the gig going, right? So Bitcoin over the long term obviously has its own boom and bust adoption cycles. And I would view Bitcoin, if you look at January 2020, right, the 60-40 equity portfolio is below its Jan 1st 2020 highs, or its opening, right? Bitcoin is 8,000 or 6,000 or whatever it was. So $20,000, right? It's drawn down 80%. It's a super volatile asset. There's a lot of beta, and remarkably, what I think I missed or underestimated, and so did a lot of analysts. We can see this kind of transparent futures market data. We can see the leverage. Oftentimes there's short squeezes to the upside, liquidations to the downside. We can see that it's natural, it's a volatile asset. What wasn't known was, and I think, maybe what was known but was underestimated, was just how much like off balance sheet, unsecured leverage there was and rehypothecation, right? So tough lessons learned. It's punished the exchange rate. But as long as you're just sitting in cold storage, if you have a long-term view on this asset class, the fact that a huge hedge fund gets wiped out and a bunch of lenders, and Bitcoin goes from 28 to 19, right? Nothing has fundamentally changed with the asset class. Blocks continue to tick. You still have a mutable ledger of property rights. What's happened is that you had, on the run up, things like Grayscale Bitcoin Trust, futures premia, and then the difference between the spot market price and the forward futures price. All these things was like fuel on the fire. And you had all these arbitrage strategies. You had the BlockFis of the world, the Celsius of the world. They all, we couldn't know what the actual Bitcoin price would have been, but they all stoked the flame to push the market higher than it would have been, right? So now on the downside, all that's getting purged and we're going lower than we probably would have gone, right? Bitcoin unwound from 10K to 3,800 in a matter of a week in 2020, right? and we're still here. Blocks are still ticking, right? So like, I think long term, could price go lower? Absolutely. I think I tell people when they buy Bitcoin, I'm like, hey, expect at any point Bitcoin can drop 50% from here, whether it's at 19K or 60K or even 10K, right? Like it can always just drop 50%. So, never lever yourself up with 100% of your stack. 2x leverage, you lose everything. Like these are bad ideas. And just have a long-term view. So long-winded answer there, but I think that the CPI inflation thing is just kind of a misnomer. And the reality is it's a long-term alternative to perpetual fiat credit debasement.
Awesome. No, I think that's a fantastic answer. I want to dive in now to the piece that you put out yesterday on Bitcoin Magazine Pro. So you start off the piece with discussing the dollar wrecking ball and the dollar milkshake. Can you provide some context into what those terms mean for people who may not be familiar?
Yeah. So essentially, post Bretton Woods, 1944, World War II, the world got together, and the U.S. is basically the strongest nation with the biggest military, and they were like, "All right, look, you guys just give us all your gold. The dollar's as good as gold. The dollar will be the world trade unit. Just price your stuff in dollars, essentially." And we'll kind of be this global dollar standard. We'll standardize, and the currencies, your currencies are linked to ours, and our currencies linked to gold, global gold standard. Well, it required trust, and long story short, the trust broke down. 1971 comes, and the U.S. was running a big deficit for stuff like Vietnam, et cetera. And the world's still using dollars, but we said, all right, our gold reserves are running low because other central banks could come in and redeem their dollars for gold at any time. Not the average citizen, but the central banks, right? That was kind of the check on the system. And Nixon was like, hey, gold tie, it's done. We're not doing that anymore. But we're still going to use a dollar because, it's just entrenched. It's still we still have the strongest economy, and we still have the biggest military. So if you want to conduct global trade, Saudi Arabia, the Middle East, if you want us to protect your trade routes, okay, cool. Well, use the dollar. So the dollar for the longest time, it has this really, really big network effect. Not only is the US the strongest economy, but everybody wants dollars. It's better than their local currencies. It has a huge kind of political fiat network effect. So fast forward a few decades, the dollar is still massively dominant in global trade. And the biggest thing is because it's used as kind of a commodities and trade unit of account, and because it's this kind of global standard, there's a ton and an increasing amount of offshore dollar debt. So you have in not domestic USA, but in Europe, in Asia, in emerging markets, you have a bunch of trade and a bunch of debt and assets in dollars, right? So this is referred to as a euro dollar system. It's nothing to do with the euro. It originated from the fact that European banks had dollar time deposits that they offered. So euro dollars is just the name for offshore dollars. So essentially, while obviously anybody in the US uses dollars and don't really think about the dollar as a kind of currency, it's just what we use. If you go anywhere else in the world, it's okay, local currency, or we'll take USD, or you can exchange your USD very easily, right? It's this kind of global standard. So fast forward a little bit more, and there's just a massive amount of dollar denominated debt. So the interesting thing is, anytime there's a slowdown in global growth, and it can happen for a number of reasons. It could just be a slowdown. It could be a credit expansion decelerating. So before you see a growth contraction, you see a deceleration of growth first, right? That kind of the derivative again. It could be commodity prices like oil soaring. It could be a number of things. But what happens is, whether it's the U.S. economy or global economy, like the every other nation, their economic activity is slowing down, makes it harder and harder to pay down those dollar denominated debts. So if you're in an emerging market, you can do a couple things. You can sell your local currency to buy dollars. Okay. Well, that makes the exchange rate, that makes the dollar go up, right? Or what you can do is you can sell your dollar assets, right? Because you have an asset liability mismatch. So what happens is asset markets fall to pay down your debt. And it's what happens, the dollar milkshake, the dollar appreciating in value, not against consumer goods like oil, but the dollar appreciating against a basket of really every currency on the planet, Bitcoin included, or risk assets. The reason why the dollar soars during recessions is because there's a massive implicit short position around the world of dollars. And what is that short position, right? The short position is dollar denominated liabilities. And it's specifically a huge problem for economies that can't print USD. Anytime the US has a problem, they print their currency. Anytime, local, emerging market and has debts in their own currency, they just print the currency. But if you have dollars, you need to go out and buy those dollars. You need to go out and trade something for dollars. And it's really, really hard during a global recession to do it. So we saw in kind of previous, periods of economic slowdown, every time we see the dollar soar. And oftentimes it's the dollar soaring that creates this slowdown. So now what we're seeing is that the dollar strengthening against the euro, against the yen, two biggest currencies besides the USD, right? The Bank of Japan and the ECB are still printing massive amounts of money and kind of, stuffing more quantitative easing stimulus into the market while the Fed's tightening back. So the dollar's soaring, risk assets are plunging. And even though something like a Bitcoin, right, which is absolutely scarce, there's no the short squeeze in the dollar. There's no dynamic like that in Bitcoin, right? People liquidate dollar denominated assets, whether it's stocks, bonds, equities, or stock bonds, Bitcoin, right? They liquidate those assets to cover their short dollar position. So that's what we're seeing today. And it ultimately, I think the end game is more stimulus and more kind of expansion of the monetary base, because there is no alternative, and the system just kind of cascades into a deflationary collapse as this dynamic plays out.
Yeah, and you made a comment in this piece about the euro and the yen essentially trading like emerging market currencies. I guess one, why do you think that's taking place? And then two, is it common, and I'm sure this is not public information, but behind the table conversations from these countries basically asking the Fed to do something before everything in their country starts spiraling out of control?
Yeah. So, I mean, what's happening with Europe, what's happening with the yen, what you will often see in emerging market currency crises, like, you're starting to see and it's exogenous events, like Sri Lanka has like a kind of their own problems, right? But when you typically see emerging market currencies collapse, like, the Turkish lira, it's, hyperinflating, all this stuff. Why does it happen? Well, I mean, one, it could be a massive amount of dollar denominated debt. They don't really have that. But right now what you're seeing with Europe and Japan is that they are huge net energy importers. So they need to go out and buy their oil. Oil, despite all of the, climate agenda, ESG, virtue signaling, oil is not just the stuff that you put in your car. Petroleum is in literally everything you touch. It makes the world go round, whether people like that or not or accept it. So, when you have an oil shortage and you're going out and buying with your currency, or, what Putin's doing and saying, hey, we don't want dollars, we don't want euros, we want rubles, and you have to go out, you have to sell your currency to do that. You basically have a situation where these central banks, are trying to solve a shortage of real goods and services, commodities, of real energy with a money printer. And it doesn't work, right? You can't print your way to prosperity. And that's why you're seeing the exchange rates, Euro USD, Yen USD, or really, if you want to look at these currencies in what matters, which is energy, they're collapsing. And so that's, the Putin, obviously not a great guy. You can say all the things, but it was a chess move. Right. Like, he bided his time for a decade, removed dollar reserves, removed dollar debt, stockpiled gold, and waited his time and said, okay, wait, we're going to pop the Western asset bubble. And we're going to do that by saying, hey, you want to sanction us? Okay, you don't get our energy. Europe, you can freeze in the dark, or, in the winter, and in the summer, you're not going to get AC because you don't have any energy. Like, Germany is like Europe's powerhouse. It's Europe's manufacturing center, right? It's Europe's factory. Germany's gone from a huge current account surplus, meaning that they export way more than they import, to a net importer, right? Like, that is massive stuff. And I think, when you're just looking at like something like the Eurozone, they're toast in this environment, which is why, the euro is falling under dollar parity for the first time in decades.
Incredible explanation. So with all of this in mind, if you had to pick a time frame where you think we start seeing the Fed change course and QE gets reintroduced, do you have an idea as to when you would predict that would start happening? How do you see it playing out, I think, over like the next year?
Yeah, so I don't have a definitive timeline. I think honestly, just for better or worse, more pain needs to be induced in financial markets, and probably something needs to break. And by break, I mean whether that's the domestic something in domestic markets or the financial system, or it could be international markets. Like, I mean, it's not in our interest to see our allies see economic collapse, but again, like the Fed can't fix an energy shortage with a money printer either, right? Like, these are structural issues, and so obviously a strong dollar relative to other currencies doesn't help too much. But it's I think what really needs to occur is and the Fed's saying this. They're explicitly telling you, like, we want demand destruction, and that comes in the form of a kind of a weaker labor market, and it also comes in the form of lower asset prices. And so, for better or worse, that's kind of what we're seeing. You see, if you look at like euro dollar futures, so we're talking about the euro dollar before. It's funny enough, like there's like an offshore market, or was an offshore market for the Fed funds rate. That's what euro dollar futures were. So the CME now has euro dollar futures, and it's essentially just a betting market for big institutions on future interest rates. And so now, if you look at, say, like December 2022 and December 2023, for the longest time, the Fed funds rate expectation for 2023 at the end of 2023 was way higher. Now it's actually the market is pricing December 2023 77 bips lower than 2022. So the market's already saying, hey, like, however high the Fed gets, they're going to have to cut again. And so whether it's QE, whether it's some form of like kind of treasury debt monetization, right? Because the government still needs to fund themselves. They still need to finance their spending, their entitlements somehow. Like, you're already seeing Europe. They have, the Eurozone has a bunch of different sovereign nations, but Italy, Greece, like, their debt to GDP is massive. So what are they doing? The Eurozone's like, the ECB is like, okay, wait, we need to help these guys. We're gonna start dampening their interest rates because they can't finance themselves otherwise. So the US is like the cleanest of the dirty shirts, but there's still a huge structural problem. Debt to GDP, public debt to GDP is still over 100%, right? Like, that with interest rates at 3-4%, like that, the math doesn't work, right? We still have all these entitlements. We still have all this military spending, all this like stuff that we spend money on. Never mind the fact that tax receipts, even though they're at an all-time high now, we have a surplus because of huge asset boom in 2021. When the economy is in a recession, you don't get those tax receipts. You don't get the capital gains. You don't. So like, this is a little bit down the road, maybe 6, 12, hell, even 18 months. But there's big structural problems, obviously, on the kind of the commodity side, the energy side. But the real like macro here is that none of the monetary, the fiscal, is nothing has changed, right? Like, the money printer still needs to go burr to solve for these debt to GDP levels. Interest rates still need to be lower than inflation for the next, however long to solve this. And so, like, I own Bitcoin because I think the solution to all this is just more of the status quo, which is, the money printer go burr.
Yeah, I completely agree with those points. One other thing I wanted to touch on with you, Bitcoin miners are under a lot of pressure. We've seen a few of the public miners like Core's, Bitfarms. Bitfarms in particular was buying Bitcoin in the 40s, sold in the 20s. We see Core's, they sold a lot of their holdings as well. So they're under a bunch of stress. As the block reward continues to decrease every 4 years, right now I was looking at the Brain Insights. They have this Bitcoin revenue chart where you can see how much of the miner revenue is from the subsidies versus the transaction fees. And I think over the past week, transaction fees has been around 1% of that total amount. Over time, as the subsidy decreases, miners are going to become more reliant on the transaction fees, which right now are low. How do you see this playing out in the future? I think what needs to change to see an uptick in the transaction fees to make that a more reliable source of miner revenue?
Yeah, I think it's obviously something that is kind of wildly debated. I think one of those things, and this is an assumption, as really all of this is, because no one really knows what the future holds. But I guess I'll start by saying my answer is that I'm not worried about the long-term security of the network. To explain why, essentially, while it's 1% today, and that block subsidy, right? The block reward is a total. The block subsidy is just the kind of that. It was first 50, 25, 12 and a half. Now it's 6.25 per block, about 900 a day. That's going to get cut in 2024 again by 50%. But really, I think the secret sauce here is the difficulty adjustment. You're going to see public miners, you're going to see really inefficient miners or even efficient miners as what's called hash price, miner revenue divided by hash rate. There's a huge economic incentive to monetize wasted or stranded energy with the Bitcoin network, right? So there's a ton of energy that's basically zero cost, whether it's flared, whether it's, non-economic use case that's way off in the distance, right? All you need is a satellite signal, some machines, and obviously some electrical infrastructure, but you can monetize all of this energy. So that incentive means that hash rate's going up and to the right for a long, long time. What that means in a kind of a situation where the revenues, whether it's in Bitcoin terms or it could be in dollar terms, let's just do Bitcoin terms for the sake of this argument. Bitcoin subsidies are going programmatically trending to zero. Hash rate is going up and to the right. So that means that your miner revenues are going down forever, right? In BTC terms, never mind the fees. So what this does is it basically kind of ratchets the inefficient miners, squeezes them out of not circulation, but squeezes them out of the business. What do these miners do, right? They capitulate, they sell their Bitcoin, maybe they don't, but they sell their ASICs. And those ASICs, we saw this with the China miner ban. They zip around the world, whether it takes 2 weeks, 2 months, 2 years, and they get plugged in somewhere where it's economical to mine, right? Like there's even still somehow S9s, which are machines that were, produced 5, 6, I don't even know how many years ago, that are still chugging along, right? And they're, there's vastly more efficient machines, but these S9s are still plugged in, right? So I think that ultimately the kind of Bitcoin mining becomes commoditized in a big, big way. And it's not something where, for much of the bull market, I could take a very average machine, stick it into my outlet in a commercial area, and it would print money, right? Like not print money, but it would absolutely churn out revenue with decent profit margins. Those days are numbered, even if they're still here today. And ultimately, I think the kind of this structure of hash price trending to zero, meaning that it gets, it's continuously squeezing inefficient miners. This will basically incentivize the most efficient use of energy the world has ever seen. And it's a really big idea. Like if someone's listening to this, they're like, that guy's crazy. But we basically have, for the first time ever, a direct economic incentive, the human race, to be as energy efficient as humanly possible because there is a direct opportunity cost that can be accessed from anywhere in the world. So I'm not worried about it. I think, I guess just the thought experiment of say the fees aren't compensated enough, right? There's a whole bunch of Bitcoin holders all over the world, whether they're zealots, whether they're speculators, whatever, that have interest in a set of immutable property rights in the form of assets, right? Like I have some Bitcoin I can store in my head if I want to. There's no other property rights that respects that there's no other asset that respects my property rights like Bitcoin does. That's just a fact. So I have interest in probably moving that or sending that or receiving that. And so if I want to, I'm going to pay a fee. If the mining isn't profitable, miners are going to turn off. Transactions are going to queue up in the mempool, and whether it takes 10 or 20 or however many minutes to confirm my transaction, eventually, because of the difficulty adjustment, because of the economic incentive to use Bitcoin and to mine Bitcoin, the difficulty will downwards adjust. Transactions will load up in the queue. More and more people will pay higher fees, and an equilibrium will be found. So, I don't know exactly what it looks like. I don't know what the fee rate will be in BTC or USD terms. I don't know, but I do know that there will be demand to use the Bitcoin network and to hold Bitcoin, the asset. And there will be an economic incentive somewhere in the world to mine Bitcoin, because there always will be, because of the difficulty adjustment. So long-winded answer, but that's kind of, I don't really worry about it over the long term. I think the difficulty adjustment's the secret sauce that makes the whole system work.
Incredible answer. Tons of insight there. And yeah, basically, I think one of the takeaways, it's a poker term, but there's a lot of outs, right? There's a lot of different ways in which someone or some entity comes in because it makes sense for them in that moment. And I've had that energy efficiency conversation with CK multiple times. I think that's really fascinating. thought experiment, because we are going to see different places in the world turn on Bitcoin mining because they have the resources to do so. And it is kind of a race to the bottom in a way, who can do it for the lowest cost. So excited to see how that global competition plays out. But Dylan, you were fantastic. Really enjoyed reading that piece. So if you are interested in any of these topics, subscribe to Bitcoin Magazine Pro. How often do you put out that piece? Is it once a week?
Yeah, so we do free content about once a week. We do paid content sometimes 4 to 5 times a week, mostly every day, and covers kind of really everything we talked about today and more.
Amazing. Well, everyone go subscribe. I'll include the link in the description here. And thanks again, Dylan. You're the man. I learned a bunch in this conversation, and hopefully we do it again soon.
Tyus, appreciate your time, man. Thanks.